Well, great. Thank you very much, Smita, Amna, and Nizar. So, talking about partnerships this morning, talking about financial inclusion, bringing more customers in. We're now going to look at that. We're going to stick with that theme, but looking at it from infrastructure technology and the role of things like CBDCs, DAOs, crypto in enabling the future of financial services, but also a future that reaches more customers. Delighted to welcome Dr. Richard Werner to the stage. Richard's going to talk about the role of CBDCs and creating more localized financial services. Richard, the stage is all yours.
Thank you very much. Thank you very much. It's a pleasure to be here. I'd like to talk about CBDCs and the quest for absolute power. And also, I'd like to talk about solutions because CBDCs, as McKinsey has found in a study on CBDCs, is not really needed. There are not many clear use cases and justifications for the introduction of CBDCs because we have functioning payment systems. So what is the value that's added? Well, there is value that's being added for some, maybe not for you, but for some. Let's have a look at that. There is a brief video clip. Is that working? No? It's only a 50-second clip. No? Okay. You have to look for it yourselves on YouTube. It'll be this gentleman who's the managing director of the BIS, that's in Switzerland, the Bank for International Settlements, which is the central bank of central banks. And he is the head of that. And this clip is only 54 seconds or something. He talks about the key difference between CBDCs and cash, which is the traditional way for central banks to provide directly to the public a payment means. Because, of course, most of our payments do not directly involve the central bank. We are used to dealing with banks or other service providers that give us credit cards or prepaid cards or Alipay, WePay, Google Pay, Apple Pay. And we don't normally deal directly with the central bank, except when we use cash. And the official story about CBDCs is, well, we have to keep up with the times. There is demand for digital payments. That's why we're introducing digital central bank currencies. But the reality is we've been using BDCs, bank digital currencies, for decades. And so what is new about CBDCs? Well, it's the C, obviously, the centralization aspect. And that's what, in this clip, Mr. Agustin Carstens makes very, very clear. Okay, I'll just paraphrase and summarize. So really he says, well, cash, when you use cash, he says, we don't know who you are when you're spending it and what you're buying with it and when. And also, we can't stop you and we can't intervene. But that's very different with CBDCs, he says. There, we have both the technology and the power to intervene, to take your money, to stop you from spending at the time you want to spend, and also for the things you want to spend. All that can be programmed. Isn't that wonderful from the perspective of central planners? So that is the advantage of CBDCs. Are you getting excited already? And also, of course, our colleagues looking at the blockchain code in Brazil have already demonstrated that the Brazilian CBDC pilot has in the program a code that allows accounts to be frozen and drained at instruction of the central planners. So that's something the central planners, of course, are very excited about. It is official. The Bank of England has officially asked the British government and Parliament to give them the power to make the digital pound, the British Central Bank digital currency, programmable, and therefore, and this is something we really have to think about, transfer parliamentary powers, budgetary powers, fiscal powers, for the first time in history, directly to the central bank as a blank check. Parliament, they have to hold debates if they have a proposal. No, we want to spend money on this and that. There have to be debates and votes, and it can take a while. Well, that's the democratic process, for good or bad. But once the CBDCs are introduced, and the whole aim is to use the technology of a programmable tool to the hilt, then all these powers have been vested with the central bank. Oh, we can just dispense with all the, the sheen and the appearance of democracy, because the central planners know best. They're technocrats. They will make those decisions when we're allowed to spend and when we're not allowed to spend. MasterCard, of course, is providing already some of the functional tools that could be connected to this, and it looks like will be connected to this. For example, there's certain shopping that you may want to do, which the central planners will discourage or simply not allow. You've exceeded your carbon footprint credit, carbon credit budget, or whatever you want to call it, or you're doing things that, we don't want you to do for some reason or other, and suddenly you won't be able to use what you thought was your money. Well, here's news. The money we hold at banks and the money we hold at the central bank is not your money. It's only a loan to the banks. It's a loan to the central bank. It's their money. And in this clip, Agustin Carstens made that clear. It's their money, and they will make sure they dispose of the money as they see fit. Actually, in June this year, they've gone even a step further. And this is where it gets really scary, I think, because I hadn't really thought this through myself. The BIS, which is the institution that is run by, the big man, says that the CBDC is not the only thing that will be, the tool that's programmable for this purpose. Actually, all assets, your bank deposits, your real estate ownership, your records, at the land registry, all that should be tokenized, because then it will be subject to seamless integration in this process and programmability. And of course, this will make it much easier to transfer your ownership, what you thought is your ownership, away from you in order to serve the greater good, of course, only for good things, would never be abused, this sort of totalitarian power, would it? But let's just remember what they did in Ottawa, the capital city of Canada, when peaceful demonstrations, and I emphasize this clearly, very peaceful demonstrations in pursuit of the democratic right to express your opinion, took place for weeks, and really annoyed, to put it bluntly, the Prime Minister Trudeau, because they dared to oppose government policies on restricting human rights and individual freedoms, the trucker demonstrations. So in the end, Trudeau decided, I don't like this. I want to stop these demonstrations right here and now. Now, because CBDCs had not yet been introduced, he had to go the long route, which was, okay, we have to pass a law now to empower the government to force the banks and the financial system to intervene as the government wishes, namely to close people's accounts, to freeze people's accounts, to bar people from accessing their money, and that's what happened. And look at it, from the police report, we learned that 206 financial products, bank accounts, corporate accounts, PayPal accounts, even 253 Bitcoin addresses with virtual currency exchanges were frozen, and the reality was the peaceful demonstrators couldn't even buy a cup of tea, get some water, get some food anymore if they hadn't brought cash with them. So all those who are into decentralized finance and freedom, don't forget, cash is not our enemy. We should also try to use cash while you use your Bitcoin as well. So that's quite shocking. And of course, it gave us a little insight into what these central planners might be doing with CBDCs. So really, CBDCs is a power tool, a control tool. Is it justified to give yet more powers now to the central planners? Is that a good idea? Well, let's look at their track record. Oh, the ECB has been quite overtly following the agenda to kill banks. And once you realize the central planners want to, they're bank regulators, but they want to step into the arena and compete with the regulated that they regulate. Is that fair competition? They have a conflict of interest. You start to understand why for the past 20 years, the policies adopted by the central planners have been very anti-bank, because that's their competition. You know how many banks have disappeared since the creation of the ECB, which is a young central bank introduced 23 years ago? More than 5,000 banks have disappeared. And they make no secret of it. They think, well, Europe is overbanked. We need to kill those banks. And they've done it. They forced them to merge. They get big. But I've shown in my work that what society needs for prosperity and a good economic outcome for the majority is many small banks. And the smaller the better, and the more the better. But they're doing the opposite. They're concentrating the banking system to have fewer banks and have bigger banks, because that's what central planners like. It helps them in the pursuit of their goals. But is it good for us? No, there is no empirical evidence for that. Let's just take an example of some of the things the central planners have done. And I dare, mention a policy that I proposed in 1995. I was chief economist at a British investment bank in Tokyo. I had warned in 91 already that while the top 10 banks in the world were Japanese, and people were saying buy Japanese stocks because they're lowering rates, it's a great investment, I was saying the opposite. Japanese banks were likely to go bankrupt. Japan was likely to move into the greatest recession since the big recession, the Great Depression. I had been working on ways to get out of what I saw was going to be a big mess in Japan, and I proposed quantitative easing. And there's different ways of quantitative easing. My proposal was QE1, QE2, which is very effective. QE1 is for the central bank to buy non-performing loans, bad assets, from the banking system. Then you clear up the problem in the banking system, and banks have clean balance sheets. The problem is solved, and it doesn't cost the taxpayer a penny. So it's a very, very good policy that doesn't increase national debt and has no cost to society. And when central banks don't want a banking crisis to turn into a big recession, that's what they actually do. But it's rare, because mostly they, it turns out, want to create a recession for their own political purposes in many countries. And certainly that's what happened in Japan, 20-year recession, because they refused to do this policy. And then QE2 is to kickstart money creation in the economy and boost the economy. Here the central bank buys performing assets from non-banks, corporate bonds, it can be real estate, anything, that forces credit creation in the banking system, pumping the money from the central bank straight into the economy. The Bank of Japan, again, refused to do it because they wanted the recession and they wanted it to continue. As I show in my book, Princes of the Yen, which was the #1 bestseller in Japan, you can get it at quantumpublishers.com. Now, funny enough, the Federal Reserve in 2008 chose to adopt QE1 when it suited it, but until then, the Bank of Japan hadn't done it, and the European central banks weren't doing it. And in March 2020, the Federal Reserve did QE2, which is a policy to expand the money supply that are designed for deflation, a shrinking economy, and a really dire situation where you want to boost transactions, boost the money supply, boost growth. They did it in March 2020 when they restricted supply artificially, and money supply was still strong at 5-6% growth, and they boosted it to double-digit growth. So this is going to create inflation. That's an anti-deflation policy, but they did it in March 2020, so it takes 18 months. In May 2020 we'll get double-digit inflation 18 months later. That's why we had this inflation. So you see how wrongly and disastrously they're implementing these policies. If you're interested, that's just the Fed for the US. You can see the data. We've got the gray line, bank credit. Okay, that's not showing up, I guess, on this screen. But the gray line is bank credit growth. In 2008, it crashed. And because of that, the money supply is shrinking. The Fed stepped in, and Fed credit creation went up, but it's entirely to purchase these assets from the banks, which doesn't cause inflation. It's no money creation, actually. It is simply rearranging the banking system at zero cost, which central banks can do when they don't want a crisis. So the Fed did this, and the US was the first country to get out of the so-called global financial crisis. The European central banks didn't do this, and they stayed in the recession longer. Then March 2020, compare that. Now here we don't have a recession, a major contraction in the money supply. Quite the opposite. We have bank credit already strong at 6-7%, and the Fed purchased assets from non-banks. That was the BlackRock plan. BlackRock was even hired in March 2020 to do that, boosting both bank credit, the gray line, and the blue line. And that is money going straight into the economy, expanding the money supply, had to create inflation. And the BlackRock plan, which the Fed adopted, said, we will create inflation with this. So it was intentional. There's absolutely no doubt. So these central planners have intentionally created the inflation. In fact, all these boom-bust cycles are created by the central planners. Should we really give them more power? Is this really a good idea? Power corrupts. Absolute power corrupts absolutely. I think it's worthwhile to fight for our freedom by preventing any further experiments with CBDCs. It is really that risky. It's the most totalitarian control tool in history. And there's no good justification for giving ever fewer people so much power. The biggest problem in the 20th century has been the ever larger concentration of power in the hands of the few. Do we really want to accelerate that in the 21st century with this control tool? Of course, it's important to realize why does this matter? Because banks are not financial intermediaries as the textbooks tell us. That's the textbook story. You get savings, the banks gather the deposits, and they lend the money. But it's not true. As I showed in my empirical work, banks are not intermediaries. They're creators of the money supply. And a loan creates new money that didn't exist before, is injected into the economy, expands the money supply. And I mean, look up, can banks individually create money out of nothing? In a peer-reviewed finance journal. It's the most downloaded scientific paper of all Elsevier scientific publications across disciplines. Here's how banks create money. They purchase the loan contract. That's an IOU, the promissory note the borrower issues, and the asset side is increased. And then how do you get the money? They credit your account because there's no such thing as bank deposits. These are the bank's liabilities to us. It's a loan by the public to the bank, and this, what is actually an accounts payable liability arising from the loan contract, is recorded as a different type of liability called customer deposit, but the customer did not deposit it. It's money creation. I could show in my work that the money for a loan is not transferred inside the bank from anywhere or outside the bank. It's newly created. And that gives banks a lot of power. And that's why it's important to have the right banks. And we need to decentralize that power, put it back into the hands of the people by creating many small banks, local banks, community banks. The more this power is concentrated in large, big banks, they work closely with the central bank. That is not really going to help us because, you see, most employment in the economy in every country is with small firms. 2/3. In some countries, 70% 80% of employment is with small firms, and small firms need bank finance. And who is going to lend to them? Big banks? No way. Only small banks. There's another empirical study where, for the first time proven this, looking at the US market, it is literally the small banks only that lend to small firms. And if you concentrate the banking system, you are killing the SME sector, the small and medium-sized enterprises. So, credit creation is done by banks, and there's good credit creation and bad credit creation. If it goes into the real economy, it has potential for good. But in some countries, the majority of bank credit creation goes into not the GDP, not national income creation, but into asset market transactions. They're not part of GDP. They don't add value. It's just changing ownership. But when banks create credit, case one, for asset purchases, you are creating money, injecting into these asset markets. Of course, what's going to happen to asset prices? You're forcing them up. That's what's creating the asset bubbles, which are always unsustainable, and if large enough, will bring down the banking system because you've boosted asset prices by 200-300%. If they drop from the peak, which they will as soon as you stop the music and stop the new credit creation for asset purchases, then they come down. They only need to fall by 15%. The banking system is bust. That's why we have the recurring banking crisis. There's two more scenarios. If bank credit creation is done for consumption, you get consumer price inflation. That's what they did in March 2020. And boy, did that play out as expected. But here, the green box, that is the redeeming feature of banking. Banks creating credit for productive business investment, implementing new technologies, increasing productivity, and that is best done, that is sustainable, that never creates banking crises, that creates wealth, prosperity for all, and we can have double-digit growth as China has proven, as Korea has proven, as Japan has proven, for decades. As long as we make sure that bank credit creation goes into the green box, which is done through central bank guidance of bank credit, which I also proved in my work. Let's just fast forward to that. Actually, yes, let me start with this. So which country has actually ever developed? Has any country developed based on IMF, World Bank, International Development Economics, Washington Consensus advice? No, there's not a single case. There are some countries that have developed, but they're all in East Asia, Japan, Korea, China and its regions, Taiwan. And they have ignored the IMF World Bank official development economics advice and done the opposite, what's forbidden by it, namely guiding bank credit through central bank guidance of bank credit to restrict the bad credit and make sure it's for productive purposes. Then you get high growth, double-digit growth. Japan announced in the 60s, 1960, we'll double national income in 10 years. Well, actually, they did it in 4 years. Why? Well, if you have 15% economic growth, national income doubles every 4.5 years. And we can do this. Every country can do this. There's no reason why we shouldn't be allowed to do it. Growth doesn't hurt the environment either, by the way. Growth is a statistical concept. The environment is hurt by environmental destruction. And you can have environmental destruction at zero growth. They say zero growth, degrowth is good. Well, no, I don't think so. The growth is not the enemy. With growth, you get prosperity. Then you have more resources to protect the environment, okay? That's another story. So Japan, double-digit growth. Korea's done it. China's done it. How did they do it? In fact, there's time periods earlier where this was done in other countries, USA, Germany. And the key tool is, it's not free market policies, free trade policies. It is intervention, clever intervention. In the credit market, it's called credit control, lending ceilings, encadrement de crédit in France, officially until the 80s even. The central banks, you see, they don't want to talk about it. They keep it as an informal, extra legal tool, but it works extremely well in Japan, Asia, and China. Window guidance. This is the window guidance bank credit quota that the central bank tells the banks. And I press the button, you see the actual bank credit 3 months later, more than 3 months later. It's a very powerful control tool when you use it for good. But too few central banks have used it for good. You know, when Deng Xiaoping came to power in 1978, he said, let's drop that politics, ideology. Um, let's do what works. He adopted the empirical, scientific methodology. Let's see what works. And he found, okay, what Japan is doing works. Let's do that. What is it? Oh, banks creating credit, guiding credit for productive use. Okay, so he switched from a monobank system, the Soviet system with one central bank, to founding thousands of banks. But today the central planners want to do the opposite. The central planners want to get rid of all these banks. You know, in Europe, Germany has the largest number of banks. That is the secret to 200 years of economic prosperity in Germany. But they're destroying it. Now they're creating a banking crisis in Germany, as I want. Asset bubble from 2009, peaking in 1 year ago. That's coming down. We'll see a slow motion banking crisis in Europe now, in Germany, centering on Germany. That was the strength of the German economy, because Germany had the largest number of hidden champions. These are small firms, SMEs. They're hidden because they're not famous, they're small, but they're global market leaders in their market niches. They're gold, silver, bronze, number 1, 2, 3, top market share in the world. Which country has most of those hidden champions? By far, it's Germany. And why is that? Because it has so many small banks, community banks. 80% of the banks in Germany, and it has the largest number of banks, are small and community banks. So I must end, and sorry for overrunning. The solution is to create banks, community banks, small banks, local banks. My colleagues at the Valhalla Network are linking this to tokens and a DAO to create banks. I'm working on founding banks, buying up banks and sort of purposing them to act as community banks, because money creation should be decentralized. And don't forget to use cash. Thank you very much.
Thank you very much. Thank you very much, Richard. Just a quick question, I think. You know, we've been hearing a lot these last 3-4 days around partnerships, the integration between technology and traditional financial services. You know, and with partnerships, of course, the brand the brand focus switches, away from the bank, i.e. the customer is thinking about the partner brand, not about the underlying bank. What's your view in the sense of over the next decade? Do you think we will see fewer banks or more banks in the markets that you look at?
Yes, that's a fantastic point you raised there. In fact, it's quite shocking what's been happening on that account, because it is led by the central planners once again. You think, oh, it's a market development. Actually, in the whole fintech industry and so on, market development. No, it was started by the central planners. They decided, we want to emasculate the banks, and suddenly they passed these laws. Europe passed this PSD2 directive, which forces banks, when you accidentally have clicked the wrong button, agree, to divulge your transactions data that the banks have never abused. They've never used this and sold it off. No, they've kept it secret. That was bank secrecy, and they've stuck to it. But with this new legislation, the banks are now forced to divulge your private data on your transactions to these fintech operators. That's the system that the central planners created because they want to kill the banks. And exactly as you say, of course, then in all these partnerships, the role of the banks is shrinking, and that is by design. But is that a good thing? Should we really diminish the banks? They're the money creators, and when they are local, they're accountable to the people. And it's the right type of banking that helps small firms, creates jobs, and gets communities to have new money creation, literally, prosperity. So that is the risk, that these things are top-down measures designed against the banks, and we have to be very wary about that.
Thank you very much, Richard. Please give
Thanks.
Richard a warm thanks.
Thanks.
We're going to switch over to our next session now. It's a very valid question that Richard brings up. How much control, how much freedom should we have over our money? And we're going to be talking now on this next session about AI. How much automation do we actually want? Both what is the opportunity for AI within financial services, but also a little bit of a conversation around what should be the role, and do we really want a fully automated financial services marketplace? Just give us 1 minute while we do a switch over, and then we'll be back with the next panel. Thank you.